Welcome to Tech Talk Tuesday. I'm your host, Carla, and with me today is my fellow co-host and CMT, David Blake. It's Monday, January 22nd, 2024, and we have some important activity to talk about that happened in the stock market last week, along with some interesting things to look out for moving forward. We do it all from a technical perspective. David, I hope that you had a great weekend. How are you doing today?
I'm doing well, thank you.
Great. Well, let's get started with last week's activity and what's ahead.
All right, well, for our second straight week last week, we saw some major weakness in the major averages early in the period. And then as the week went on, it kind of reversed itself. And once again, it was led by the mega cap technology shares and semiconductors. In fact, this week, semiconductors were up about 8% on the week. And I think the week before they were up on 5 or 6% that week. So they're up 14, 15% and striking new highs as we're moving forward here.
Okay, and how did the major indexes finish for the week?
But we also last week saw the Dow Jones, the S&P 500, the NASDAQ 100 also post new record highs. NASDAQ still has about 500 or 600 points to go, but it is a new 52-week high in the NASDAQ and also a 2-year high. I believe it peaked in November of 21. So a couple strong days, and I think we'll probably see a high in the NASDAQ also.
What kind of market moving data did we receive last week, and how did that affect things going forward into this week?
And we had some pretty rough manufacturing data early in the week. I think it was the Empire State Manufacturing Index fell like to a minus 47. They were expecting a minus 5. Then that was followed the next day by better than expected retail sales, which caused some trepidation in the yields. They ticked higher on that, thinking that, okay, well, the Fed's not going to cut rates. But then along came Thursday, and we did see another pretty good drop in jobless claims. I think the initial jobless claims dropped by 16,000, and we had the continuing claims drop by about 25,000. And so at this stage, all of a sudden, we're starting to get some analysts saying that forget about the soft landing. We may not have any landing at all if things keep going like this. And that was followed on Friday by Taiwan Semiconductor reporting blowout earnings, and they raised their guidance for 2024. Like I said, the Philadelphia Semiconductor surged 8% last week. A lot of this is forecasting we're seeing in guidance is due to AI. They're as we start this week to see. I'm not sure what all the high tech with, but Microsoft and Apple, some of these companies are starting to come out. NVIDIA with their earnings, and they're going to be talking. Investors hope about what's going to happen with AI. They're expecting to see them announce that AI guidance is going to really kick their earnings higher over the next three or four quarters. So we'll have to see if that's going to happen or not. But raised guidance is always a good thing for the market.
And I think we also saw a recent high in the 10-year Treasury bond as well. Is that correct?
We did see the 10-year Treasury had gotten as high as 4.18%. That's its highest mark since December. I believe back then, I think we actually hit 5.10 or something like that. And then it finished the week at 4.13, which is, it's still high. But as far as a March rate cut, I've been telling you, I don't think we're going to see a March rate cut. And that's dropped from 77% probability of a rate cut just a week or so ago. I think now we're down to under 50%. So less than a coin toss that we'll see a March rate cut. However, because of earnings coming in a little bit better than expected, and the hope is that some of these tech companies will raise guidance, we're seeing the market still rally in the face of steady interest rates, which is kind of interesting because if you remember, just like 2 or 3 weeks ago, they were some were calling for 5 or 6 rate cuts over the course of the year. And now they're actually pushing it out to maybe June for the first one. So we'll see how that plays out.
Moving on to market sectors, which sectors of the stock market were the leaders and which ones were the laggers?
As far as the sectors that led the advance, we saw technology sector and communication services, I believe, strike new highs last week. Financials were close to a new high. Now that's interesting because it's not really the banks that are pushing the financial sector to new highs. It is to a degree, but they're just kind of, they're off the lows. They're up, 8, 9%. But a lot of that big gain in the XLF is due to Visa and MasterCard and some of these other pay now or buy now, pay later stocks that are really taking off again. Then as far as the weak sectors, we saw rate sensitive sectors, utilities, REITs, consumer staples. They were some of the weakest groups. Then as we saw a little bit of a turnaround in the rates, we'll keep them higher for longer. That's not especially good for rate sensitive sectors. And we also saw weakness in energy and materials. And the energy sector, it's kind of interesting because despite, we did see crude oil prices go up for, I think, a second or third week in a row, but they are fairly contained, I think, because considering what's going on in the Mid East. You would think, other historically in times of the past, you would see prices up near $100 a barrel with all this stuff going on. So we'll see how that goes. Today, I believe we're seeing crude oil go a little higher again. But one of the things that I'm noticing is a little bit strange is we're not seeing gains in Chevron, Exxon Mobil, or any like the Devon Energy and stocks like that. We're not seeing much of any gains in those. They're kind of going sideways to lower. So we'll kind of watch that for a little bit. Not sure exactly why, because they're still going to make a lot of money here and have great earnings, but we'll keep an eye on those. It might be something to look at here, probably going forward.
All right, so communication services gets the top step of the podium for the market sectors of last week. So moving on to the underlying technical condition of the market, how are we looking going into this week?
Okay, the technical condition of the market, it was mixed for a second week. And we did see investors rotate into the big cap technology shares again. They call it the Magnificent Seven. The technical indicators also finished mixed. We had, momentum still looks is positive. It has slowed down considerably. We had a nice uptick in that last week. But the MACD, which is a short-term trend gauge, was still bearish for most of the major averages. It's bullish for the Nasdaq, and S&P 500 was getting close to crossing to a bullish cross. So it's I still think we probably can tick higher here for a little bit, another week or two, but we might start to see some questionable market action. One of the things that we like to look at as technicians, secondary indexes, which includes small cap Russell 2000 and Dow Jones Transports. I noted last week that Russell 2000 was down last week for a fourth consecutive week. That's not the sign of a broad-based market rallies. That's kind of telling you that maybe things are getting a little toppy. Another thing that I noticed that actually was on the good side of that, with this 4-week pullback in the Russell 2000, it actually came down, and so did the Dow Jones Transport, to their respective 50-day moving average, and it kind of bounced around there and then went up a little bit Friday, I believe. Now you want to kind of watch that. If that holds, I noted that if that holds, that could induce buying over the near term. Today, as I looked, was what just a minute ago, we see the small caps are up 1.5%. So that came true last week. The fact that we were able to hold that support level for the Russell and the transports, they responded and buyers came into those two indexes today. So Russell up today at 1.45%, and the transports are holding that support are up 1.82%. So that's actually telling us that we're probably going to see this market go up, at least in a couple of weeks.
Fair enough, but how is the market sentiment doing right now?
Now, sentiment is back pretty much almost to neutral. I mean, there's still more bulls and bears, but we did see a little bit. It was kind of surprising that the National Association of Active Investment Managers Exposure Index dropped all the way down to 53.5 the week before from 80.2. And that's just telling you perhaps they were lightening up after the first of the year. I'm not sure. We'll have to keep an eye on that. Finally, I wanted to mention that underlying breadth like I say, it's still spotty. And part of that is the fact that as we're stepping into new highs, the NYSE and NASDAQ advanced decline lines, and we consider those leading indicators of the market direction. last peak 4 weeks ago. As we were coming out of December, the last week of December is when NYSE advanced decline line peaked, which means that for the last 3 weeks of this rally, you're having more stocks going down than going up, which is not what you want to see if you're going to break out to on a real strong bullish rally. So that's something you want to watch.
What kind of market moving events are we looking forward to coming into this week?
Now this week, like I said, we get some earnings from big cap technology companies. And again, the buzz is that we'll see raised guidance on the potential of AI related issues. And investors are counting on that offsetting the higher for longer path for rates. If we don't see the guidance as strong as what maybe the market is expecting, then maybe we could go those little sideways and maybe start to see a pullback. But so far, I don't think you're going to see that at this stage. That we do see the negative divergence, which means you want to still be cautious in here because everything's not confirming the prices are going higher. There's enough going on here that I think we can probably turn higher a little bit, but I don't think I would be jumping all in with both feet. Now, one of the reasons that I also add that we're going to probably go to keep going higher for a little bit longer is once everybody starts to read that the market's making new highs, you get a lot of, especially after like a year or two, like what we've had here, you start to get a lot of people come off the sidelines that were in the market before, then they lost the market. Now they see it's making new highs again, and they start bringing in money off the sidelines and investing here when you're close to a top. That on top of the fact that there's $8 trillion or something like that on the sidelines right now, which is a humongous amount of money that some of it will work its way back into the market. And finally, one last thing I wanted to bring up was that at the end of December, we'll get another reading this week. But at the end of December, short interest on the NYSE and the Nasdaq had dropped more than 4% towards the last 2 weeks of December. So that takes off the bit where if you hear somebody saying, "Oh, it's probably a short covering rally that we're seeing pushing the market to new highs," that's not the case in this instance. I think that what's happening is you're seeing like the summer, you're seeing the big cap technology, the overweighted issues pulling the whole market up, and just the fact that we're seeing new money coming off the sidelines of that eight trillion. It's not a instance where a lot of traders are on the wrong side, or that we're short the market and now have to cover. So that's not what we're seeing. So for just to wrap it up real quick, I think we have a couple more weeks here where we can probably see this thing chug higher, and then we'll see how the earnings play out and go from there.
Okay, well, you mentioned that we're seeing similarities between the current rally and the summer rally. Can you explain that a little bit more?
Yeah, it goes back to the fact that remember in the summertime, all of a sudden we were talking about the Magnificent Seven, and they were going up making new highs every day, and they the rest of the market was kind of iffy, and you started the AD lines were going down. Can we go to a chart? Let's go to charts and look up SPY, and maybe we can show you this. Let's expand this out to go up to like 2021, pull it forward that way. Okay, now go pull this up a little bit. Maybe if we can make it smaller would be good.
All right.
Okay, go put your arrow around June 11th, about mid June or so, 23. Okay, now on the bottom thing there, that's the ADL, and that's kind of the advanced decline line that we have in there. As you can see, it peaked right there on June 11th or so, came back up a little bit, maybe 2 weeks later, and then it worked its way down. As it's going down, the market was going higher, and that's what I mentioned when I said that you have negative breadth, and that's considered negative divergence. And what happens is that in this case, the NYSE line today, the NYSE AD line peaked the last week of December. So it peaked 4 weeks ago. So that is telling you that usually like this chart shows, it's like a kind of runaway train when you're having a big move like this, like we had in the summer. It just keeps on going up, despite the fact that while it's going up, people are coming up, jumping off the train and getting off. More and more people are getting off at each station, and that's kind of what you've seen here the last three weeks. Despite the fact that we're making new highs here. More people are getting off of each station. And that's something that you want to keep an eye on, this negative divergence, because that's kind of a forewarning. Unless all of a sudden something happens that all of a sudden you see a big pickup where we have a couple of days where the advanced declines are like 2,500 advancings to maybe 500 decliners. If that starts to happen again, then we can probably see another good move. That's probably when you'll see the Nasdaq make a new high. But when you see this negative divergence like in the advanced decline line like that, it's something that you want to be aware of. Carla, go to the market at a glance thing real quick too.
Right.
That's here on the home page. They just move that around a little bit. Let's go down to the AD line here. Okay, and now here, especially on the Nasdaq here on the right hand side. Okay, so we'll look at the NYSE first. Okay, here we are making new highs, and you can see over here that what I was just talking about, where the AD line, the NYSE peaked back in December. Okay, and you can actually draw trend lines on these. So you can't on this thing, but you can on even on if there are advanced decline lines like this, you can still draw trend lines to see if they're holding support. And in this case, you can see that if you draw one, if you print this off and draw it on yourself and keep it on your desk or something like that, when that advanced decline line, if it cracks back above a downward sloping trend line that you would draw on there, that would be an indication that, okay, well, maybe we're picking up or contributing issues here. So that would be something like that. But then look at the Nasdaq advanced decline, and it's not as pronounced as the NYSE. In other words, you have more junk issues in there. So a lot of times it doesn't quite. It's not quite the forward guidance that the NYSE is. But you can see there is the Nasdaq has been outperforming the last couple of weeks, to say the least. This thing looks pretty poor. Looks pretty weak, and that's something that we want to keep an eye on. You can actually draw a trend line, print that off and draw a trend line too. And then I'll just kind of give you a hint that, maybe the rally is broadening out. But this stage right now, you want to kind of, just the fact that this negative divergence is showing up in some of these indicators makes you want to look, just be a little bit more cautious. Again, part of this is when you do see an index make new highs after a extended period of time, like what we've had. A lot of people reading about it on the weekends and stuff. All of a sudden they go, well, the market's making new highs again. I need to be in. Let's jump in here and buy somewhere. They're going in, and so maybe some of the professionals are coming out, and that would be a little bit of a worry for me. So I would just I'd let this ride for a little while and until the negative divergence either corrects itself or the market decides to have a little bit of a pullback.
All right. Well, that is actually very helpful information, David. We are actually close to running out of time for this week, but is there anything else that you would like to add going forward to this week?
No, I think that just pay attention to the earnings this week, and as we get these big cap technology companies reporting, that could send the market up sharply higher. If you get the Nvidia and Microsoft and some of these other companies just saying that they're looking for the AI related issues to really add to their earnings going forward, then you're probably going to get another big rush to the upside, and that would you don't want to be on the side, you don't want to be out of the market for that.
All right. Well, there we have it. Thank you for all the helpful information, David. We actually have to wrap up this week's Tech Talk Tuesday. Thank you to everyone for listening, and we will catch you all again next week.